Hey everyone, welcome back to today's video. Today, we're going to check out this very interesting video, and hopefully, you'll learn something new along the way. Let's dive right in. Don't forget to leave a like, subscribe, and share your thoughts in the comments. And now, without further ado, let's get into it.
So you want to learn a strategy on how to become successful in trading. And if you're watching this, you've probably watched many others and you are not successful in trading. You haven't made money and you want to know how to. Well, let me tell you something. The markets have completely changed right now with Donald Trump coming into office. And this is my latest and most updated strategy that will make you successful in 2025 and for the rest of Donald Trump's term, because the markets have changed greatly and we have reacted and adapted to it very fast to capitalize off of it. So welcome to this video. Let's begin. So for those of you guys that don't know, my name is Alex G. I've been trading for the last 7.5 years and I have made well over $10 million in the financial markets just trading currencies alone. I've done crazy flips. I've taken $100 into $1 million. I've shown everything publicly, the whole nine. But something is happening right now in the market that even affected me as a experienced and successful trader. And it's a pattern that I saw in my journey as a trader. When I started trading 7 years ago when I was working at Dunkin' Donuts, I started trading in the Trump markets. And for 2.5 years, I was finding it very difficult for me to become successful in Trump markets because it was very unpredictable and I was also getting started in trading. So I didn't become successful. Then Biden got elected and the Biden markets came in, which were very slow, very easy pace. And I became not only a successful trader, but I became the trader and the person that I am today, where I have made tens of billions of dollars in the markets from trading alone. And now the markets have changed back to the Trump markets, and I see the same patterns that I saw when I started trading 7 years ago. Markets don't respect market structure. Trends aren't following trends how they should. Entries are having major liquidity grabs, fake outs, and wick outs. And on top of that, you need more extra confirmations to enter a trade because Trump is coming out with new laws and new regulations every single day, and all our markets are being affected by it. Now, this caught me by surprise because since I'm used to trading Biden markets, when new Trump markets approach, I am used to trading a certain type of market volatility. And from 1 week to another, everything completely changes. I entered a 2-month losing streak. My entries weren't playing out as they should. And I had to take a step back for a second. I'm like, oh, wait, hold on. The strongest currency in the world, which is the US dollar, has now changed from Biden's hand to Trump's hand. And Trump is going to do everything he possibly can to make the dollar stronger, even if it's going to cost the US money to do that. And it costs other currencies to do that. And why does that even matter for the foreign exchange market? Because you can't just trade one currency. You can't just trade USD. You have to trade the USD versus the euro, the USD versus the pound, the USD versus the yen. So if you're trading the yen short or the yen long, you're also trading against or with the dollar. And this can have major fluctuation in price. And even if you're not trading the dollar with other currency pairs like NZD CAD, for example, you're going to see a great effect in that market just because the strongest currency in the world is going through so much change right now. And now this can be a good or a bad thing depending on what side of the table you're on. If you don't have any experience, it's going to be a very difficult time for you to learn these new markets. If you have some type of experience, then it's going to be easier for you to adapt from Biden to now Trump. And if you're an expert like me, it takes you some back testing for you to realize what is going on that has happened in the past. Now, I've always been against back testing because I personally don't believe that it works, but in a moment like this, it is very needed. And I have found something where I have now somewhat modified my strategy to the most updated and latest version in 2025. The basis of my strategy still remains exactly the same. I'm not changing the foundation of it. I'm just being a little bit more conservative, being a little bit more strategic with areas of interest, and waiting for extra confirmations, where we're going to break everything down in this video. Oh, and if you're a scalper, day trader, swing trader, intraday position trader, investor, you are being affected by this no matter what, but it's okay. In this video, I'm going to teach you how you can use this strategy to your benefit, and you're going to be able to capitalize off of it and not be confused on what's happening in the markets. Oh, and to clarify, nothing is actually changing from my strategy. I'm still trading with the trend. I'm still entering at an area of interest, and I am still looking for an entry signal. The foundation is the same. What changes is how I do it. Now, I'm going to give you the best example and analogy that I can possibly do. What I was doing in the Biden markets is I would go to the beach, I would get a surfboard, and I would surf a wave. Now, the way this works is, as a surfer, your job is to go to the beach, find the best beach that has the cleanest waters, has the most amount of waves, doesn't have any sharks, doesn't have any rocks, so you can have a great surfing day. The second thing is you want to make sure that your surfboard is waxed. You want to make sure you have the tie strap tied to your ankle, and you want to make sure that it has all the rubber on top, so when you get on, you don't slip off. And then the third is when you're in the water and you're looking to enter the wave, you want to make sure that you enter the wave in the middle, not too high, not too low, so you don't fall. Now, keep in mind, I give you this analogy without me ever surfing a day in my life, but you understand the concept behind surfing. Now, fast forward to Trump markets, I am still a surfer, but now the only difference is that when I go to the beach, instead of me looking over the top of the beach to see if there's any sharks, if there's any rocks, usually beforehand that would take me 1 to 2 minutes because I would trust the beach. Now it's going to take me 1 to 2 hours because I want to make sure that I can look a little bit more in depth if there's any sharks further out in the ocean, if there's rocks hidden under the waves. Before I actually even go to the beach, I want to make sure that I have a brand new surfboard, that it is waxed freshly in the morning, not prior nights, and I want to make sure that the tie wrap is brand new. And when I go into the water to actually enter the wave, I will only enter at the middle of the wave. In the last markets, I would enter at the top, middle, bottom, and I would still ride the wave perfectly, and there was no risk of me falling. But now in the new markets, I'm being a little bit more conservative at what point I would enter. Now, if you notice, I'm still a surfer in both markets. The only thing that changes is I am a little bit more conservative here and be a little bit more respective of the ocean. Why? Because you have to respect the ocean because you never know what it's capable of. And that's exactly what happens in the markets. With the Biden markets, I got very comfortable. I was very used to taking trades that were somewhat sporadic or high risk. That worked out great. But now the markets have changed. So what I'm doing now is I'm just being a little bit more conservative and I am respecting the markets more. And just like any beach that you go to, there's a risk of there being jellyfishes, there being sharks, there being stuff in the water. And even though some beaches do have a lot of it and some don't, doesn't mean that one beach is better than the other, because from one day to another, these things can appear. All we're doing now is we are being more aware of it and being more conservative and respecting it more because we understand that there's a higher risk associated with it. And this is how a mature trader would be thinking with Trump markets like this. A beginner trader would completely disregard that now there's obvious visuals of sharks, of rocks, of jellyfish in the water, and what happens? They get caught, they get eaten by a shark, and then they have a bad experience from the beach and surfing, and they never want to do it again. But not us as experienced traders. We understand it, we change our mindset. Instead of being aggressive, we're being defensive, and we're being very strategic with this because we find more opportunities and we capitalize off of it. So now, this is the mindset parts and the mature way on how to approach the market. Now I'm going to teach you how to actually trade the market. And these are going to be the exact steps that you need to use in order for you to actually enter a position exactly how I do it nowadays. So the first thing that you want to look at when you go trade into the markets is going to be the trend. The trend is your friend, and trust me, you do not want to trade against the trend, especially inside of these new Trump markets. The best analogy and simplest analogy is if the waves are surfing west, don't try and surf east. Go with the waves. It's going to be a lot easier rather than fighting them. Same thing here in the markets. When we go identify a trend of the market, we always have to start from the top down, meaning we have to start from the highest time frame to the lowest time frame so we understand where the majority of the time frames are headed. For example, we're going to be using the weekly, daily, and 4-hour to understand the basis of what this trend is doing. And then after we understand what these time frames are doing, we will use a 2-hour, 1 hour, 30-minute, and 15-minute to look to enter the trade. So out of all of these 6 time frames, 7 time frames that I have here, they are grouped by what they will be used by. The higher time frames, weekly, daily, and 4-hour, is purely for trend and area of interest. The 2-hour, 1 hour, 30-minute, and 15-minute is purely for entries and has no association with the trend. It's a very simple analogy as well, is these higher time frames are the big waves, these lower time frames are the small waves. You're not going to enter on a small wave. You always want to enter the big waves. You got a longer surf, you get cooler pictures, and it's somewhat safer to enter a wave further out in the ocean rather than very close to the shore, because there's rocks, there's sharks, there's people, etc. So when we go understand that the market is bullish or bearish, we want to make sure that we can tell based off of the market structure. Market structure is going to be every single one of these elbows that we have that creates a high point, a low point, and a high point. This market here has shifted from being bearish to now being bullish. This market currently is bullish, with this being the latest higher high, and with this being the latest higher low at this point right here. So this is the start. We have the weekly time frame bullish. So we would take out our trusty notes, we would put weekly, and then we would put bullish. Then we would go down to the next time frame, which would be the daily, and we would get an understanding of what is the daily doing. Is the daily bullish or is the daily bearish? So same exact structure. We would start from here, higher high, just say higher low, higher high, higher low, higher high, lower low, lower high, lower low, and this daily body engulfed above that structure point. So technically this would then be bullish as well. So here we have daily bullish, and then we would go to the 4 hour. So we go down to the 4 hour. On the 4 hour, we would be able to read the market structure and determine if this is bullish or bearish, because as of right now we have 2 time frames telling us that the market is heading to the upside, which already makes more logical sense to buy rather than sell. Trading is already 50-50. It's either going to go up or going to go down, and you want to create the most amount of confluences that you possibly can, so you enter this trade in one direction rather than the other. So if we were to read here the 4 hour, say we start off from here, higher high, higher low, higher high, market has shifted here bearish, then we created a lower low, and currently we are still bearish because this right here is the lower high at this structure point right here, and this is the lower low at this structure point right here. This is bearish because the body of this structure point did not body close above this right here. I don't count the wicks. The wicks are not real market structure. The wicks are just wicks. It's where price has been in the past, but price never really actually closed or stayed there for a period of time. Way that you can look at a wick is as if you were to have your feet wet and you walk into your house. If you go from your door to the kitchen, you leave a trail. But if you stay at the kitchen, that's where you end up staying for, let's say, for a picture. You got caught that you walked into the house with wet shoes at the kitchen, not at the door. The footprints from the door to the kitchen is the trail. This wick right here is the trail, but where you got caught was here in the kitchen, which is where the closure of the body is. So technically you didn't get caught because of the trail, because the trail could have been anybody else. You got caught because you got caught being at the kitchen with the wet shoes. So the trail doesn't really count to identify if the market structure is bullish or bearish. That is just the history. What matters are the bodies. And if we were to add the line chart to this, as you can tell, the lines, they'll create points at these structure points, not at the wicks. You notice every single line is at the body of the move and not at the wicks, because market structure is purely off of the bodies, not off of the wicks. If I remove the candlesticks, you can see here how this would be the lower high, lower low, and how none of these wicks are being factored into the equation, because once again, wicks don't count. Now, wicks don't count for this specific example. I'm going to explain you what wicks count later in the video. So we understand that this time frame is now bearish, which is cool because now we understand that we have 2 higher time frames heading to the upside, and then we have 1 time frame heading to the downside. No big deal. The strategy remains the same. We need a minimum of 2 time frames in sync in order for us to take this trade into the direction that the consecutive time frames are in. And these consecutive time frames are the weekly bullish and the daily bullish. So this means we have 2 consecutive time frames that indicate buys, we're going to purely be looking for buys. We're not going to be looking for sells. If this were to be the other way around, let's say the 4-hour would be bullish and the daily bullish as well, we would be looking for buys as well. But let's say that the weekly is bullish, the daily would then be bearish, and then the 4-hour would be bullish. We would not be looking for a trade here because there is no 2 consecutive time frames in sync in order for us to be taking this trade. But since that is not the case and we do have 2 consecutive time frames, we will be sticking to buys purely. So now that we understand that the market is bullish, we then move on to the next, which is going to be the area of interest. So areas of interest are only identified on 2 time frames, especially now in the Trump markets, to have a high probability trade, which is simply going to be on the weekly and on the daily. And this is for a ideal intraday / day / swing trade. You want to look for a swing trade for an area of interest on the weekly. You want to look for a day trade with an area of interest on the daily, and maybe on the weekly as well for an intraday trade, because you want to hold this position for a little bit longer. In this example, this is going to work perfectly for both examples, for an intraday trade, day trade / swing trade. So since we understand that this is the high point, and since this is the low point over here, let's just place this one as the higher low. We understand that the area of interest could only be looked for inside of this higher high and higher low. This could not be a area of interest, because if price were to make it to this point right here, price would then shift bearish and we are no longer bullish, meaning that this market would then have a lower low, and then this would be the lower high, making the weekly time frame bearish and not bullish, which we should not be interested in buying. So we have to make sure that the area of interest that we place is being placed inside of the higher high or higher low. And if for a coincidence you're a beginner watching this video and you don't understand how I'm marking this market structure so fast, or how I'm identifying an area of interest so fast, and you don't even know how to read market structure, make sure you subscribe to this channel and you check out my other videos, because I have videos that teach you how to do specifically one of these things for a very long period of time and to the T. Now I'm just teaching you the strategy, not the how-to of each thing inside of my strategy. So make sure you check out my other videos, which are going to be right here. Make sure you hit the subscribe button to this channel as well. So back into finding the area of interest, which is going to be the second step into identifying a high probability trade with the strategy that I use inside of Trump markets. We identify this as the higher high. We identify this as the higher low. We could only find an area of interest working from this high point down. Now, an area of interest can only consist of a minimum of 3 touches. If we do not have 3 touches, an area of interest is not valid. And an area of interest is basically what it is set. It is an area of interest. It's not a line. It's not a dash. It's not a trend line. It's a little zone. And the zone should not be bigger than 60 pips. If you notice, this zone right here would be exactly 41 pips. And again, I have videos set on my channel explaining on why it shouldn't be bigger than 60 pips. So this right here would not be a valid area of interest, because we only have 1 tap, 2 taps, and that is it. A valid area of interest needs to have a minimum of 3. So this would not be a valid area of interest. So we would start from this point here. We would put our higher low and we'd keep working our way down, and boom, we would make it to this spot here where I already have the area of interest marked up, because this right here has 1 tap, 2 taps, 3 taps, 4 taps, and 5, which is a much stronger area of interest, if you ask me, if you were to compare it to this zone right here. Where do you think price action would have more of a reaction from? From an area that has 1, 2 taps, or from an area that has 1, 2, 3, 4, 5, even 6 taps? Obviously the 6. You want to put your money behind the zone that is much more respected. Perfect analogy, if we were to talk about surfing, you would much rather enter a wave that gives you more an indication that it's not going to just crash as soon as you enter on it, rather if it is. This is the exact same example here. But inside of the higher high and higher low, there could be more than 1 area of interest. So we can keep working our way down, working our way down, working our way down, and then we can run into this structure point right around here. Let's make sure that this is not bigger than 60 pips. and this is right around exactly 60 pips, which is perfectly fine. We have 1, 2, 3, 4, and 5 taps. So both of these are weekly areas of interest, meaning we would want for the weekly to come back into these areas in order for us to enter this trade for a long position for a weekly trade. So we would have this as a weekly area of interest 1, and then this would be weekly area of interest number 2, where we would anticipate for the weekly to have a retracement here or here to then have the reaction that we would need to enter this trade to the upside. This is the ideal swing trade. Now we're going to go down to the daily time frame and find a daily area of interest so we can have a daily day trade and not have to wait as long for price to retrace back up into here. So the daily time frame, since this would be the higher high at this point right here, and technically the higher low would be at this point right here, we'd have to look for an area of interest inside of this higher high, inside of this higher low. So if we were to drag this out to the left, we can start working our way from the top down. Obviously not as big of a zone that we would want, but we're just, I'm using a realistic example from the markets. You notice here, what do we have? We have 1, 2, 3, 4, 5 taps at this area of interest. We could even make it a little bit tighter, which would be even better for price. Here we have 1, 2, 3, 4, 5 taps, meaning this is the valid daily area of interest. There is multiple rejections from this area. So what would we need in order for us to take this trade to the upside for a day trade is a retracement here to buy. If that opportunity does not present itself to enter this trade here, what will then happen? The daily time frame would then shift bearish, and once it shifts bearish, we would head to our weekly area of interest, where then our weekly area of interest number 1, we would then look for entries to execute the trade at this point here. So the beauty of this is the beauty of my strategy at least is you don't have to only be a swing trader or only be a day trader. You're setting up a scenario on whatever the market gives you the opportunity. And it's going to make a lot more sense now when we go into the entry point. So after you understand now the entry point for a potential day trade, an entry point for a potential swing trade, I'm going to set you the entry area for now, the day trade, which would then go down to the 4 hour, 2 hour, 1 hour, 30 minute, 15 minute. In the 4 hour, we would understand that this would be the retracement area. We would understand that the 4 hour is bearish because that is the lower high and this is the lower low. But you may be asking, Alex, would you still take the trade to the upside even if the 4 hour is bearish? And the answer is sure, but I need a valid rejection pattern in order for me to enter this trade. And this is where we're now going to enter the entry area of the strategy, which is going to be the famous head and shoulders pattern. Whenever you enter a trade, it's because you're entering the reversal of the move that is happening at that point. Perfect example is going to be if the market is bullish. When you're entering a buy, you're not entering a buy at the highest point. You're entering the buy at the retracement, anticipating for the next push to the upside. Inside of this push right here, there's going to be bearish structure to make it back into this area of interest. Inside of this bearish structure pullback, that price is going into your area of interest. What you need to wait for is going to be a reversal pattern or a shift of structure, also known as a head and shoulders pattern, which has been one of my most successful patterns, has made me tens of millions of dollars in the markets by just simply waiting for it. Does it happen all the time? Yes. Will it happen all the time? No. You need to be very patient for it. And sometimes you'll enter it, sometimes it won't work, sometimes you'll even miss it because it doesn't give you that pattern. And that's perfectly fine. This is our edge and it's part of the game that we're trading. So price will have a retracement back into this area of interest. And as of right now, it is potentially creating that inverted head and shoulders at this area of interest. So what I would need is for price to make it to this right shoulder and then break that neckline, have a retest of it, and then we will enter this trade to the upside. Perfect example that I can do this is this one right here. There is a high point, we have a left, we have a head, and then on the right shoulder, what did we do? We broke the neckline and then we retested it. This is an example of it playing out perfectly. This is an example right here of a left head and then a right shoulder, and it never broke the neckline. So if we would have been taking this sell, what would have happened? We would have taken a loss if we don't wait for that extra confirmation. So before, when I was trading the Biden markets, I would just take the trade anywhere in the pattern of the head and shoulders just because it worked very well. Now, in the Trump markets, I must wait for the break and then the retest of the neckline of the head and shoulders. It is the only confirmation that I will wait for to enter the trade. I am not entering a trade beforehand, and I am not going to enter a trade in the middle of it. It has to happen a perfect break and retest. If not, I will not be entering the trade. Because as you can see here multiple times, not only did it work here once it did it, here once it didn't do it, it didn't work, and then here as well. If you notice, this looked like it was creating a left, a head, and here on the right shoulder, it basically never stopped. Before in the Biden markets, I would take this trade here all the time because I would anticipate the right shoulder, but that is no longer the case. I must wait for a shift of structure, or also known for the head and shoulders pattern at the area of interest. And if I were to get this pattern on the 4 hour, if I were to get this pattern on the 2 hour, the 1 hour, the 30-minute, whatever looks the cleanest. What I will say is I will stay away from the 15-minute. I haven't officially moved it away from my strategy just yet because I want to test it a little bit more with the Biden markets to see if I can implement it somewhere in the strategy. But in the last 3 months of me using the strategy with the Trump markets, I have found zero use for the 15-minute time frame. If anything, it's just confusing me a little bit more. So for now, I don't want to completely remove it. I still want to give it a chance. I've been using it for the last 7 years of my trading, and it's kind of I'm kind of attached to it. It's made me money, it's lost me money, but I don't see a lot of use of it now in the Trump markets. And before I make that decision, I want to collect more data personally as a trader so then I can make that decision. So once you do have your head and shoulders pattern that has formed, which for example, let's say this forms like this, and then we have our break and then our retest of our neckline of our head and shoulders, we would look for price to then have the entry signal, which we would enter the trade at the neckline, and then we want to make sure that we can give it a breathing room from either the right shoulder or the head of the move. So this would be the right shoulder, this would be the head. Perfect example from this head and shoulders, we can either give it a breathing room from, well, the right shoulder happens to also be higher than the head, which is perfectly fine. But let's say if we were to be taking this trade right here, we can either give it a breathing room from that right shoulder, which is this one right here, left head, right shoulder, or we can give it a breathing room from the head. It would just depend on how big your risk to reward is and where your take profits would be placed. And that goes on to my next point, which is part of the entry signal. And it is, if you're going to be entering a day trade, you have to place day trade take profits. If you're going to be entering a swing trade, you have to place swing trade take profits. It's just simply how it works. And your stop loss needs to directly correlate with that, because you cannot enter a trade unless you don't have a minimum of a 1 to 2 risk to reward. Any trade below a 1 to 2 risk to reward, even if it's a 1 to 1.5, it is simply not a profitable risk to reward. It is not going to work. All of my trades are a minimum of a 1 to 2. And lately with the Trump markets, I've been cutting them off right at the 1 to 2. I created the slogan set and forget. I even trademarked it. Like, I literally own the word set and forget. I own it. And I have not been set and forgetting lately, because Trump, in the middle of your move as you're set and forgetting, can tweet something or come out with a new law, and there goes all your profits. You can be taken out at break even, or your trade can just completely reverse against you. And this has happened for many of my trades throughout this whole entire week. I can show you trades here like Euro JPY, where I was nearly at my 1 to 2 risk to reward. Price came back into my entry. NZD JPY, price was nearly at my 1 to 2, and price came back and took me out of stop loss. You want to make sure that you're being conservative. Here in this example, I could have not been greedy and looked for the extra profits and closed here at a 1 to 2, but I wanted that extra and make it all the way to a 1 to 3, and look what happened. So with these Trump markets, the main thing is going to be being conservative and sticking to the strategy. Are opportunities going to present themselves? Yes. Are they going to come every day how they used to with Biden markets? Not right now. We have to give it some time for us to adjust and evolve with the markets. And every single week, I break down these markets with my students. I'm breaking down every single trade that I take before, during, and after inside of my private community. I break down where I'm exactly looking to enter, where I'm exactly looking to get out. I'm doing live updates on my trades with other thousands of successful traders that are using my strategy and practicing it in real time. We have traders from all around the world. We have traders from all different ages, different professions, capitalizing off of these opportunities that we're getting every single day. So if you want to be part of the Set and Forget community where students are making anywhere from $1,000 to $1,500 a week using the Set and Forget strategy, make sure to click the link in the description below. I have a video for you there that explains to you what our community is about to see if it even makes sense for you. Because truthfully, it took us a period to adjust now to these Trump markets, but I will tell you this is only the beginning of it. We have a very long term ahead of us, and the opportunities are going to be endless for us to capitalize off of it. I hope to see you inside of the community soon. Make sure to hit that like and subscribe button, and I hope to see you inside of the Set and Forget community. I'll see you guys in the next video.